President Trump's administration implemented a series of tariffs based on a controversial calculation methodology that has drawn widespread criticism from economic experts and market analysts. The stated goal was to address trade imbalances and protect American industries, but mounting evidence suggests these policies have produced unintended negative consequences for both domestic and global markets. The implementation came with promises of economic revival and protection for American workers, but the actual outcomes have diverged significantly from these expectations, creating complex challenges across multiple economic sectors. Subscribe to our channel for more in-depth economic analysis and policy reviews. Don't miss our upcoming coverage of global trade developments, market reactions, and expert assessment. The implementation of these tariff policies triggered an immediate negative market reaction, with U.S. stock markets reportedly losing approximately $2 trillion in value shortly after the announcements. This unprecedented market response signals deep concerns from investors about the long-term economic viability of these trade policies and their implications for global commerce. Jim Cramer, a notable market analyst who has historically been skeptical of free trade policies, expressed significant disappointment with the implementation of these tariffs, stating, "I feel like a sucker tonight because I am not a free trader and I do not believe in free trades. What I was hoping was a coordinated thing where if you are charging us 20%, we charge you 20%. Kramer's assessment is particularly notable coming from an analyst who had previously expressed support for stronger trade measures but found the actual implementation problematic in both concept and execution. He described the administration's mathematical approach as ridiculous and fundamentally flawed, highlighting the gap between the intended policy outcomes and the actual methodology employed. Tariff calculation methodology. According to documentation, the Trump administration calculates tariffs using a formula that divides the U.S. trade deficit with a country by the total imports from that country. For example, with China, the U.S. trade deficit of $295.4 billion divided by total imports of $438.9 billion results in a tariff rate of 67.3%. This approach has been criticized by economic experts for several fundamental flaws. First, it does not account for existing tariff levels imposed by trading partners, creating potential double penalties. Second, it applies tariffs to countries with trade surpluses with the U.S., despite them not necessarily having protectionist policies. Third, it lacks economic justification in its application, appearing arbitrary rather than strategic. The simplistic nature of this calculation has been criticized for failing to account for the complex realities of international trade relationships. Many economists argue that trade deficits are not inherently negative and reflect broader economic patterns rather than unfair practices. By using deficits as the primary calculation factor, the policy misdiagnoses the nature of international trade and applies remedies that may exacerbate rather than resolve economic challenges. Economic consequences. The implementation of these tariffs has resulted in several significant domestic economic consequences. American consumers have experienced direct negative impacts through higher prices for everyday consumer goods, increased costs for manufactured products with imported components, and reduced purchasing power due to inflationary pressures. For businesses, the tariffs have created substantial challenges, including disruption to manufacturing processes reliant on imported components, increased production costs, and uncertainty in long-term planning. Many companies have been forced to absorb these additional costs, reducing profitability, while others have passed them on to consumers, further fueling inflation. The stock market response reflects these concerns, with substantial value losses affecting retirement accounts, investment portfolios, and overall economic confidence. These effects have rippled throughout the economy, creating challenges for businesses attempting to maintain competitive pricing while absorbing increased costs for raw materials and components, ultimately affecting both corporate profitability and consumer spending power in ways that counteract the intended benefits of the tariff policies. International responses. Canada has implemented the most documented and comprehensive response to these tariff policies. Their retaliatory measures include 25% tariffs on U.S. imported automobiles that do not comply with USMCA agreement, 25% tariffs on U.S. goods valued at approximately $30 billion, effective March 4, 2025, and additional tariffs on steel and aluminum products valued at $12.6 billion. The economic impact on Canada has been significant, including the closure of the Windsor car assembly plant affecting approximately 3,600 workers. However, Canada has been strategic in its approach. avoiding tariffs on auto parts to protect integrated production systems that benefit both countries. This measured response demonstrates a sophisticated understanding of the interconnected nature of modern manufacturing that appears absent in the original U.S. policy. Beyond economic measures, public sentiment in Canada has shifted, with reported boycotts of U.S. goods and services, cancellation of travel to the United States, and cultural demonstrations of disapproval. These social responses highlight how trade policies can affect broader international relationships beyond purely economic considerations. Other nations have also implemented retaliatory measures, including Japan, the United Kingdom, Australia, and European Union member states, targeting American exports such as soybeans and other agricultural products. These international responses have created a complex web of trade barriers that undermine the integrated global supply chains many industries have developed over decades of economic globalization. Policy contradictions and unintended consequences. The tariff policy appears to have created contradictory effects for American farmers, with tariffs imposed on Canadian fertilizers and energy imports that are essential inputs for American agricultural production, resulting in increased production costs. This demonstrates how broadly applied tariffs can create unintended negative consequences for the very sectors they aim to protect. Global supply chains have experienced significant disruption, with companies unable to effectively plan production and distribution due to rapidly changing tariff landscapes. These contradictions highlight the challenge of implementing broad tariff policies in a deeply interconnected global economy, where production processes often span multiple countries and depend on efficient cross-border movement of components and materials. The unintended consequences have been particularly pronounced in sectors where American competitiveness depends on access to global inputs at competitive prices. Many manufacturers rely on specialized components from international suppliers, and increased costs for these inputs have reduced their ability to compete both domestically and internationally. The evidence suggests that President Trump's tariff policies, while intended to address trade imbalances and protect American industries, have resulted in significant negative economic consequences. The calculation methodology appears fundamentally flawed from an economic perspective, failing to account for existing trade relationships and creating arbitrary tariff levels. The domestic economic impact has been substantial, with market losses, inflation, and job disruptions. International responses have been swift and targeted, further compounding economic challenges. The Canadian response has been particularly comprehensive, affecting both economic and cultural relations between the two nations. These findings suggest a need for reassessment of current tariff policies to mitigate ongoing economic damage and restore international trade relationships that benefit all parties through more nuanced and targeted approaches to addressing legitimate trade concerns. A more effective approach would involve diplomatic engagement, sector-specific strategies, and coordination with international partners rather than broad, formula-based tariffs that disrupt global trade without achieving their intended goals.